Thank you for tuning in to LeadDeveloper.com, where we simplify complex property development feasibilities, investment analysis, and everything real estate. Whether you're a seasoned pro or just starting out, our Google Sheets-based feasibility suite streamlines the toughest aspects of real estate. Lead Developer Feasibility Suite is trusted by thousands in over 17 countries. Our tools cover everything from quick assessments to detailed cash flow projections and more. Sign up today at LeadDeveloper.com for unlimited free access to our expanding library of real estate tools. No credit card needed. Plus, get full support through Edge with step-by-step guidance, exclusive courses, and resources designed for your success. Turn numbers into narratives that win over investors and lenders. Join Lead Developer now.
Welcome to our deep dive into property investment finance.
What?
Today, we're going to be looking at this comprehensive guide for new and seasoned investors.
Sounds good.
Really to kind of break down how to think about the financials of property investing.
Yeah, and it's interesting, the guide jumps right in with a bold statement saying that buying an investment property is the best investment you will ever make.
Oh, wow.
And while real estate can be an amazing way to build long-term wealth, there's definitely nuances and risks to consider.
It's not a get-rich-quick scheme.
No.
It's really a journey.
Yeah.
And it requires you to plan and really execute well. Mm-hmm. And, the guide emphasizes the importance of the formula.
Okay.
Solid overall return equals cash flow plus capital gains.
Right. So it's not just about the property going up in value over time.
Yeah.
It's also about the income that it can generate.
So if you imagine you have a rental property, the cash flow represents the rent you collect. Mm-hmm.
And the capital gains is the profit you make if you sell it for more than you bought it for.
Exactly.
And those two have to work together to get your return on investment.
And the guide does a pretty good job of laying out the pros and cons.
Oh, yeah.
The potential for appreciation and passive income is really attractive.
Right.
But it's really important to consider those upfront costs, the maintenance, and just the time commitment.
Yeah. Managing a property is a lot of work.
It is. It's not a passive endeavor.
Right.
It requires research and due diligence and ongoing management to really make it work.
Okay, so let's jump into kind of a fundamental concept here, which is equity.
All right.
And the guide defines it as the portion of the property that you own outright.
Okay, so let's imagine this.
Okay.
You buy a property, and of course you make a down payment, and the rest is financed through a loan.
Right.
Equity is the difference between the market value and that loan amount.
So it's your ownership stake in the property. It's exactly.
So the guide gives an example.
Okay.
Let's say you buy a property for $500,000.
Right.
And you put down 20%.
Okay.
Which would be $100,000. Your initial equity would be $100,000.
Now let's say the property value goes up over time.
Okay.
And a few years later, it's worth $600,000.
Wow.
If your loan amount stays the same, your equity is now $200,000.
So you made $100,000
just through the value going up.
just by the property appreciating.
Yeah.
And then the guide goes on to say you can then leverage that equity to buy more properties.
Right. So you borrow against the equity you have, and that gives you the funds to invest in another property.
So you can really kind of like snowball your investments.
Exactly. It's a powerful strategy, but we got to approach it carefully.
Of course.
And understand the risks.
Okay, so now that we understand equity a little bit, let's talk about lenders.
Okay.
Where do you get the money to actually finance these properties?
So the guide talks about several different types of lenders. We've got traditional banks, non-bank lenders, and even private investors.
Oh, wow. So there's a variety.
There is.
Of options.
Yeah. And they all have different criteria.
Okay.
Different risk appetites, different areas that they like to lend in.
So banks are probably the most familiar.
Right. They're the ones that we know the best.
But they might have stricter rules?
They do. They often have very strict lending policies.
Okay.
And they might not be flexible if you've got a complicated income situation.
And the guide actually mentions a bunch of income types that lenders treat differently.
Like overtime, pay, casual income.
Yeah.
Investment income.
Okay. And that's where a mortgage broker comes in.
Right. A mortgage broker can be super helpful.
Yeah.
Especially if you're a first-time buyer or if you've got a unique financial situation.
So they can kind of help you navigate all that.
Yeah. They're like a matchmaker.
Yeah.
They connect borrowers with suitable lenders.
Okay, and then the guide says we have to pay attention to the comparison rate.
Right. And that's really important because the comparison rate goes beyond just the interest rate.
Okay.
And looks at all the fees and charges.
So it gives you a more accurate picture of what it actually costs to borrow.
Exactly. So you can make a good decision.
Okay, so we've got equity.
Yep.
We've got lenders. Now let's talk about the types of loans and mortgages that are available to property investors.
It's like a buffet of options.
There's a lot out there.
There is.
And the guide starts with the classic debate between standard variable rate loans and fixed rate loans.
It's the battle of the ages.
It is.
So variable rate loans, they have interest rates that can fluctuate over the loan term.
But fixed rate, they're locked in for a set period.
Exactly. Usually 1 to 5 years.
So each one has its pros and cons.
Yeah. Variable rates give you flexibility. And there's the potential that the rates will go down.
But they could go up, too.
Exactly. That's the risk you run.
And fixed rate.
Yeah.
At least you know what your payment is going to be.
You've got stability.
Right.
You've got peace of mind.
But maybe rates go down.
Yeah. And then you're stuck.
And you're paying more than you would have.
Right. So it really depends on your risk tolerance.
Your goals.
Yeah. Your financial situation.
Okay. And then the guide mentions a few other types of loans.
Right.
Split loans, lines of credit, and offset accounts.
Those are really interesting options.
Okay. So break those down for us.
So a split loan lets you split your mortgage into different parts.
Okay.
Each with its own interest rate.
And so you can kind of have one part that's fixed and one part that's variable.
Exactly. You get the best of both worlds.
I like it.
And then lines of credit.
Yeah.
It's like a big pool of money.
Okay.
That you can borrow from as needed.
So if you want to renovate or you have an unexpected expense,
exactly,
then you can use that.
Very versatile.
What about offset accounts?
An offset account is a transaction account.
Okay.
That's linked to your home loan.
Okay.
And basically the balance in that offset account reduces the amount of interest you pay.
So if I have $50,000 in my offset account and a $500,000 loan, I'm only paying interest on $450,000.
Exactly.
Oh, wow, that's cool.
Yeah, it can help you pay your mortgage off a lot faster.
So there's really a lot to consider.
There is.
When it comes to the right loan for your property investment journey.
Yeah, the guide is a great starting point, but it's always good to talk to a professional.
Get that personalized advice.
Exactly.
All right, so we've covered a lot of ground. We've talked about equity lenders, different loan options.
Yeah, there's a lot to think about.
It's clear that property investment finance is kind of complicated.
It can be.
But the guide goes deeper.
Okay. Into some specific types of loans, investment loans and construction loans.
Those are both designed for particular situations.
So investment loans, I assume, are specifically for buying properties to rent out.
Exactly. They're tailored for investors.
Okay.
Often come with features like interest-only repayments.
Okay.
Or you can deduct the loan interest from your taxable income.
Oh, so there are some tax advantages.
Yeah, but they might also have higher interest rates.
Okay.
Or stricter rules than regular home loans.
And what about construction loans?
Construction loans are for people who are building or renovating.
Okay.
And the way they work is different.
How so?
The money is released in stages.
Oh, so as the construction progresses.
Right, so it's more complicated to manage.
Yeah, I can imagine.
But it gives you the financing you need.
To build that dream home.
Exactly.
The guide also has some good advice for first-time home buyers and people looking to expand their portfolios.
So for first-time buyers, one of the biggest tips is
minimize LMI, lender's mortgage insurance,
right,
which protects the lender.
Okay.
If you don't pay back the loan.
So if you borrow more than 80% of the property's value,
usually,
you have to pay that.
And it can add a lot to your loan amount.
So if you can't come up with that 20% deposit.
Yeah, there are options.
Like what?
Family guarantors.
Okay.
Or longer loan terms.
So family guarantors are basically
someone in your family who vouches for your loan.
So it lowers the risk for the lender.
Exactly.
And longer loan terms.
Yeah, your monthly payments will be smaller.
But you pay more interest overall.
Right. But it makes it more affordable.
Okay. So what about experienced investors who are looking to buy more properties?
One of the best strategies is using the equity from your existing properties to buy new ones.
So like we talked about before, as your property value goes up, your equity grows.
Exactly.
And you can borrow against that.
Right. And that gives you the money to buy more.
So you're kind of building this snowball.
Yeah. Your investments gain momentum.
Yeah.
And that generates more equity.
That you can use to buy more.
Exactly.
Okay, now let's talk about two terms I always get confused by.
Okay, shoot.
Negative gearing and positive gearing.
those can be tricky.
Help me out here.
All right, so negative gearing is when your rental income is less than the expenses you have for the property.
So you're losing money.
Technically, yes.
So why would anyone do that?
Because of the tax benefits.
Okay, explain that.
In some countries, you can offset those losses against your other income.
So you might actually save money on taxes.
Right, even though you're losing money on the property itself.
So it could be a good strategy for certain investors.
Exactly, especially if they're in a high tax bracket.
But there's risk involved.
Of course.
What if the property value doesn't go up?
Or if the rental income drops.
Right, you could lose more than you planned.
Yes, you got to be careful.
Okay, and positive gearing is the opposite.
Right, that's when your rental income is more than your expenses.
So you're actually making money.
Exactly, you've got a positive cash flow.
That sounds less risky.
It can be, but you'll probably pay more in taxes.
Because that rental income is taxable.
Right, so it's all about finding the right balance.
Yeah.
And choosing a strategy that works for you.
Okay, now let's talk about taxes.
Right.
Specifically, capital gains tax, or CGT.
Which comes up when you sell an investment property.
Right, you make a profit when you sell it.
Yeah.
And you have to pay tax on that profit.
That's CGT in a nutshell.
But there are exceptions, right?
Yeah, like the main residence exemption.
Okay.
If you've lived in the property yourself.
And if you hold the property for a long time.
Yeah, that can reduce your CGT too.
So it's important to understand all the tax implications.
Absolutely.
Now, so far we've been talking about traditional financing, like bank loans.
Right, but there are other options out there.
The guide mentions a few.
Yeah, like equity release for homeowners over 55.
Okay.
Self-employed loans. And even deposit bonds.
Those sound interesting.
They are.
Can you tell us more?
So equity release.
Yeah.
Lets older homeowners access the equity in their homes.
Okay.
Without having to sell.
So they can use that money for other things.
Exactly like retirement income.
And self-employed loans.
Those are for people who don't have traditional income documents.
Okay.
Like pay stubs or tax returns.
So it's easier to qualify.
Sometimes. But they might have higher interest rates.
Okay, what about deposit bonds?
A deposit bond is basically a guarantee for your deposit.
Okay.
So you don't have to put down a lot of cash up front.
So it frees up your money for other things.
Exactly.
These alternative options sound great.
They can be, but they often come with higher interest rates or stricter terms.
So you have to weigh the pros and cons.
Right, and talk to an expert.
Okay, now the guide talks about SMSFs.
Self-managed super funds, which can be used to invest in property.
It sounds complicated.
It can be, but it's a powerful tool.
Okay, break it down for me.
So an SMSF is basically a way to manage your own retirement savings.
Yeah.
And one of the ways you can invest those savings is in property.
So you're using your retirement money to buy an investment property.
Exactly.
But there are rules.
There are.
What are some of the key ones?
The property has to be held in a trust.
Okay.
Specifically for your SMSF.
And you can't live in it?
No, you can't live in it.
Or rent it to family?
Nope.
And there are limits on how much you can borrow.
Right. SMSF loans usually have lower loan-to-value ratios.
Loan-to-value ratio. Can you explain that one?
It's just the percentage of the property's value that you're financing with a loan.
So, like, if you're buying a $500,000 property and you borrow $400,000...
Your LVR would be 80%.
Okay, so SMSF loans often need a bigger deposit. And they might have higher interest rates.
They often do.
Okay, so it's really important to do your research.
Absolutely.
Before using your SMSF to invest.
Talk to an expert.
Okay. As we wrap up this section, the guide mentions a few more things.
Yeah, it's like a grab bag of extra stuff.
It is.
Family pledge loans, split contracts.
Okay.
The 5 C's of credit.
Can you explain those?
So family pledge loans.
Yeah.
That's where you use a family member's property as security for your loan.
So you're basically putting their property at risk.
You are.
If you don't pay back the loan.
Right. So it's a big decision.
For both of you.
Oh, definitely.
What about split contracts?
Those are common in property development.
Okay.
It lets you buy the land and the building separately.
So you don't need all the money up front.
Exactly. You can buy the land first.
Yeah.
Then get financing for construction later.
Oh, that's smart.
Yeah, it's a flexible approach.
And the 5 C's of credit.
Those are the things lenders look at to decide if you're a good borrower.
Okay, what are they?
Character capacity, collateral capital conditions.
Okay, break those down for me.
Character is your credit history.
Okay.
Lenders want to see that you pay your bills on time.
Capacity is your ability to repay the loan.
Right, so you look at your income, your expenses, your debts.
Collateral is the property itself.
Exactly. That's the security for the loan.
Okay.
Capital is your savings investments.
Okay.
Shows your financial strength.
In conditions.
Things like the economy, interest rates, the loan terms.
So lenders really look at everything.
They do.
It's like a financial background check.
It is, but if you understand these 5 C's, you can improve your chances of getting approved.
So maintain a good credit score. Show them you manage your money well.
And have a solid plan for your investment.
It's all about building trust with the lender.
Exactly.
Okay. The guide also mentions GST registration.
Which can be confusing.
It is.
GST is goods and services tax.
Right, a tax on most goods and services.
And sometimes property investors have to register for GST.
When would that happen?
If you're doing property development.
Okay.
Or if your rental income is above a certain amount.
And what does that mean for investors?
You have to charge GST on your rent.
Okay.
And send it to the tax office. You could also claim GST credits.
For expenses related to your investment.
Exactly. So it could be beneficial.
But it's complicated.
It is.
Okay. And finally, the guide talks about arrears payments.
Yeah, those are bad news.
What are they?
Payments that are made late.
Okay.
Like your mortgage, credit card bills, utilities.
And why are they bad?
They hurt your credit score.
And your credit score is important.
Super important.
Why is that?
It shows lenders how reliable you are.
Okay.
A good score means you're more likely to get approved for a loan.
And get a good interest rate.
Exactly.
So paying your bills on time is crucial.
It's all about managing your finances well.
Okay, this has been a lot of information.
It has.
But I feel like I'm starting to get a grasp on property investment finance.
That's the goal.
I'm excited to see what else the guide has to offer.
Me too.
Okay, so we've talked about equity lenders, loans, negative gearing, capital gains tax, alternative financing.
A lot of stuff.
It's been a whirlwind.
It has.
But I'm feeling more confident about property investment finance.
Good. That's the whole point.
And the guide emphasizes having a solid lending structure and finance strategy.
Just exactly.
Okay, so let's break those down.
Right.
What is a lending structure?
It's the details of how you're going to finance the investment.
Okay.
So things like the loan amount, the term, the interest rate, the repayment schedule, any special features.
So like offset accounts.
Yeah, redraw facility.
Okay, so it's basically the blueprint for your loan.
Exactly.
And it should align with your overall finance strategy.
Right, which takes a broader view.
Okay.
Looking at your goals, your risk tolerance, your timeline.
So what are some of the key parts of a good finance strategy?
Well, you want to think about your deposit amount.
Okay.
Your desired interest rate, how much you can afford to repay each month, the type of property you want, your time frame, and your exit strategy.
Exit strategy.
Yeah.
What's that?
How you plan to sell the property eventually.
Okay.
Will you hold it for a long time or sell it sooner?
To free up funds for other investments?
Or to take advantage of market changes.
So having a clear exit strategy helps you make better decisions.
Exactly. You know where you're going.
And the guide mentions mortgage underwriting.
Ah, yes. The mysterious world of underwriting.
What is that?
It's how lenders decide whether to approve your loan.
So it's the make or break moment?
Pretty much.
What are they looking for?
2 main things.
Okay.
Profitability and default risk.
They want to make sure they're going to make money.
Of course.
And that you're going to pay them back.
Exactly.
So how do they figure that out?
They look at your financial history. Your credit score, income expenses, assets, debts. They also look at the property's value.
To make sure it's worth enough.
Right.
So it's a pretty in-depth process.
It is, but you can increase your chances of approval. Have a good credit score.
Go.
Show that you're good with money. And have a solid plan for your investment.
Okay, so it's all about building trust.
Exactly.
Now the guide keeps saying, seek expert advice.
It's so important.
It seems like property investment finance.
Yeah.
It's exciting.
It is.
But it's also really complex.
Definitely.
And while this guide is helpful, it's not a replacement for professional advice.
Right. Talk to financial advisors, mortgage brokers, property lawyers.
They can help you navigate everything.
They tailor strategies for you.
Make sure you're making the right decisions.
Exactly.
Okay, so as we wrap up this deep dive, what are some of the key takeaways?
Well, first, knowledge is power. The more you know about property investment finance, the better decisions you can make.
Second, property investment is a journey.
Right. It's not a get-rich-quick scheme.
It takes time.
It does.
And planning.
Yeah.
And a willingness to learn.
And adapt.
Adapt.
Okay, and finally,
Don't be afraid to ask for help.
Yeah, find those experts.
Build a team of professionals you trust.
Okay, thank you so much for guiding us through this deep dive.
My pleasure.
It's been really insightful.
Good to hear.
I feel like I'm ready to tackle my property investment goals.
Awesome.
Property investment can be a great way to build wealth.
It can.
And achieve financial freedom.
And with careful planning and the right guidance,
yeah,
you can make your dreams a reality.
To our listeners, thanks for joining us.
Yeah, thanks for listening.
We hope you found it valuable.
We'll see you next time.
Until then, happy investing.